So how expensive is a stock's price? That's a question that everybody wants to answer. One common measurement or valuation is the price earnings or PE ratio. So to talk about PE ratio, we first need to talk about earnings. And for this discussion, earnings equals profit. And the way I describe how a company makes profit is if you played with Play-Doh as a kid, you used to have those little plastic machines where you put the Play-Doh in, you turn the crank, a shape of Play-Doh comes out the other side. Think about that. What goes into the Play-Doh machine is capital, cash, equipment, intellectual property. That's what goes into the Play-Doh machine. Then when you turn the crank, that's when you're creating a product or delivering a service. Then what comes out the Play-Doh machine, that shape at the end, that's profit. So we put capital in, we turn the crank, we make a product or service, earnings come out the other end. So that's a way of thinking about earnings. So let's think about a price earnings ratio. Let's say that the common stock price is 80, the earnings per share is 10, the PE ratio is 8 times earnings. So 80 stock price divided by $10 earnings per share equals 8 or 8 times. Now we have something going on, which is why I'm doing the video, that PE ratios for the S&P 500, that 500 basket of stocks, that basket of 500 stocks, is relatively high based on history. So based on the Wall Street Journal a few days ago, the average PE ratio, assuming that we're thinking about forecasted or future profits, what analysts expect, the PE ratio is at 22.5 or 22.5 times expected future earnings. That is a relatively high PE ratio. It hasn't been that high many times in the past 40 years. One time it was that high was before the dot-com bubble burst in the 99-2000 range. So the thing to remember here is what the PE ratio is, market price of the stock divided by earnings per share, and the fact that right now in the summer of 2025, PE ratios for the S&P 500 are relatively high.